Hello. Looks like Bletchley's already in the chat. Welcome, everybody else. Would you join me? Hopefully, I won't be as long as Friday today. We'll just try and blast through a little bit. There's not a lot changed from what we spoke about on that last video, but it is worth going through the week. The PDF wasn't ready, but I'll send that round after the live show when they finished it. But I'll run through it. We did look at a few things on Friday anyway. The live show today, just like the preview I've got posted up there, we'll just have a quick look at and chat through Apple, central banks, what it all means for the earnings setup for the week, and just go through a few things that I've put in the weekly preview as to why it's probably just a rotation and not a crash, etc. And then hopefully you've all got a few questions today, and we'll go with that. As it's been a quietish session so far, hasn't it? Opened up gold, as I said, I think had an issue. Lifetone Mizzy Sar gold, Sean B gold shorts. I mean, we set it up on last week that we're going to have a look at 2400 and then see what happens, and we're still in that kind of what happens next. There's obviously the expiry into Friday. It looks like quite a few people ended up short the physical, which they scrambled back in today, I think, with that Asian session move. I'll show you the CME page again. It's always worth checking into the end of the session for any late changes on Friday. I know most people have probably given up, but that is something to check before Monday's session starts. And we'll have a quick look at that page. But yeah, I mean, the whole thing with gold, I think we've got that 2350 kind of support level for where we know there's definitely some physical. That is where they might try and push it down to the next couple of sessions. But, I think Gustav put up a good setup earlier. There are a number of options in the short term. Right. Yeah, please hit the like, because then they might even let me keep doing it. If it's useful, then certainly give it a like. Right, let's have a look at what I've done for the preview. Right, that's more like it. Nope. We're obviously running slowly. It's very hot here today. I think I've probably got far too many tabs open. Yeah, no, Bletchley, thanks. I've just had I've been working on another project, which unfortunately I've left a load of tabs open. I'll be with you in a minute. Someone else is sharing. Who's that? Nose of Forex, Planty, a sweet one. Interesting. Right, I will be back. I'm just going to stop this because there seems to be somebody locked up on my screen. Hi, Vinny. Hi. Right, we're having a small issue here. Right, everyone. I will be back in about a minute. I'm just going to restart my streaming engine that will feed the YouTube. So, one sec. Right, I think we're back. Hopefully, you can all see that now. Yeah, brilliant. Thank you, Bletchley. Right, off we go then. Right, I'll just run through a few things. Hopefully, you all enjoyed that. Fantastic opening ceremony from the French, Papa Smurf, etc. That was absolutely brilliant. I used to watch a program growing years ago called Euro Trash with Antoine de Kern and Jean-Paul Gaultier, and this was like a 3-hour spectacle. Absolutely brilliant. And it's obviously got lots of incoming from people who didn't enjoy it, so which is even better. Should make it an Olympic event. Politics-wise, yes, obviously lots of chatter. Saw something quite interesting from someone saying a big issue for America in this whole thing, and the reason why Trump possibly ends up winning, is that it's a bit like Rishi Sunak, that we ended up being forced to have Rishi Sunak by the Conservative MPs as Prime Minister without having a vote on him. And the same thing's happened with Kamala Harris. So regardless of whether she has the right policies or not, the public at large may not necessarily buy into it just because it hasn't gone through the due process. Not really the American way. I mean, obviously, it's quite a bizarre thing to have happened, but that might just be something to be aware of in the next couple of months, that the whole, even though it might flip-flop around in the polls, when push comes to shove, people may well end up not voting or vote for Trump. And really, the polls have come together. The real politics or clear politics poll that they do, main business media channels, have got them quite close. But it's all about the swing states. It's all about, just like over here, Reform won 13% and got 1 or 2 seats. Similarly for the Greens, whereas they got a bigger share than the Liberals, who got 71 seats. I think the American setup is there's a few swing states, aren't there, that the national poll doesn't really affect. So just be careful of doing your market bets based on politics. That's it, real clear politics. This afternoon, Rachel Reeves, the UK Chancellor, will speak. That might have just as much effect on sterling as what the MPC does on Thursday, just mainly because she's already whinging about taking over a bad economy. Everyone does when a new government comes in, but they're going to spell out what their spending situation is this afternoon. So look out for any worries about doing unfunded stuff. You might suddenly have a few sterling jitters. I think it's 3:30 this afternoon. And then generally for the week, we have got obviously the three central banks, the Bank of Japan first, followed by the Fed, followed by the Bank of England. What's going to happen at the moment? There's a lot of pushback on whether the Japanese are going to do any kind of rate rise at all. The issue for them is consumerism. They've got the rate of inflation is in the right area, has been for a number of months, above 2%. They're worried that if they seem to put rates up too quickly, they will stop the sort of momentum there. I think, ironically, on the same day, they've got large retail items numbers out. Whether that's showing what they need really is, even though wages have been put up, a lot of the money hasn't been received yet. And you've got a generation that haven't seen inflation, so a lot of people don't really know how to react. So what are we going to get? Probably a slow path reduction to 5 trillion yen per month on the purchasing, and then an idea that they'll cut later in the year. I don't think that's enough to stop people buying UJ again. So just be careful of some volatility around that. 10 basis points is probably the max that anyone's expecting. That might see them have a go at pushing the yen back below 152. But to me, unless they signal 25 and they're really here to stay and they're going to keep doing it, then people will come back to taking on that carry trade. I think there was just an overall risk-off trade last week around the continued carry trades around the globe just being taken off because a lot of people, the consensus place to hide was in the Mag 7. Someone described it as getting into lifeboats into Mag 7 while they're unsure about the rest of the economy and the global economy. Now that things look like the rate cutting cycle is going to come out in force as an insurance policy, it's sort of safe to go back into investments, but that involves this rotation taking place. Sooner or later, it's going to be all boats moving in the same direction. Just depends how big this actual tech rotation trade is. I'd like to think that it's done too much, which is one of the points I put. The Russell 2000 versus Nasdaq 100 since the 10th of July, it's almost a 20% reversal. That seems, and on the basis you normally go within a month of the first cut, they've even gone early there versus it being in September. We shall see what happens. So if that is to continue, then we're only halfway through the correction. But I still think this week, and we'll look at the earnings that are coming, is the biggest week for tech. Alphabet has always been on the periphery of being accepted, and Tesla's a bit of a joke. So this is the week for the big boys and the real trends. And of the proper stocks last week, SAP in Germany, which is a global stock really, and enterprise software with real AI exposure, and ServiceNow, which is generative AI into other companies on the ground. And one of the things that's really coming through is that a lot of companies at large just don't have that data in the right format to be able to benefit from AI. So there's a real underlying sweep through the economy. AI really is helping and happening to just tidy people up to make them ready for AI. So we really are at the beginning of all this rather than everyone saying we're at the end and topped out valuation wise. And this week, I think Microsoft, Apple, and Amazon AWS probably are the ones that will drive this. In the meantime, what's the Fed going to do? We said on Friday, zero chance of them doing anything really for July now. But the GDP was okay. PCE, no issues on Friday, so they can start making noises if they want. They don't necessarily have to because they've still got Jackson Hole in August where they could change their setup. But so far, every opportunity Powell has been as dovish as he can be. So don't rule out him saying something. Will the market push it? Can it really push it any further than having 100% chance of a September rate? It's probably a little bit of a nothing, unlikely to have much to get in the way. We've got Jolts and ADP before that, haven't we? the way the data set up, it's the first of the month on Thursday, so that you get ISM after the Fed meeting. Obviously, we've got non-farm payrolls on Friday. Thursday, that also has the PMI, the market PMI. They were fairly strong around the globe, a little bit. Will that come through in the States? The S&P Global was weak, manufacturing-wise, wasn't it, last week? Services was okay. So it's a case of, is this really signs of recession or is it rotation? Lucian WDO put no, it wasn't. It was Luke Randall, wasn't it? Put up the chart that I was talking about last week, which is the inversions. It's not the inversion that causes a recession. It's when the yield curve starts re-steepening. It's when you're normally on the outside chance of a recession. I'll just answer a couple of questions there. Bletchley, will the value of USA debt with the Fed keep rates higher than the rest of it? No, because they're not really interested in that. It's not their mandate. The bond purchases and sales is to do with the Treasury, so they are separate. It's all about keeping the economy and pricing levels in line. So Fed aren't really that bothered. They're offside on their bond purchases anyway. So they've got an incentive to get bond prices back up, really, from the purchases they've made. Afternoon, Julie. Astro Gunboat, what kind of, we're looking at, well, you just take yourself out, mate, if you're not interested. Actually, spending down, do you see the impacting Big Five in NASDAQ as less tech purchased? Well, no, if anything, the issue is that CapEx is being seen to be too big for the Big Five. People are saying, are they going to earn enough to justify it? That's the kind of thing that Alphabet were caught up in. Meta last time had the same problem, and they will have that question this week. And I'm slightly concerned about, at the end of last week, they were on the verge of buying a stake in Ray-Ban for augmented reality. That's just the sort of thing that's going to wind everybody up. So I think the market should really be prepared, given the reaction to Alphabet, for the same reaction in Meta. It's what happens with the other three, which I think potentially could knock it out of the park. Where is the bar for all that? As a Bloomberg tech guy said today, Amazon is probably the best one to watch on Thursday because that touches everything. There's not only have they got massive cloud spending for the AWS and the AI spend, but they also have the consumer side to it as well. So you will definitely get an idea of where the whole mixture is. Apple, loads of upgrades late last week. They've just thrown a curveball. Don't know if you've seen that today. I've been talking about slightly delaying the AI update into the new phone. So you might have to get that as an upgrade, software upgrade afterwards, which a lot of people were hoping that it was all going to be tied up straight away with the new launched phone. But as long as it's only 1 to 2 months and it all comes together, I think they'll be forgiven. But anything beyond that, that might be an issue for the Q3. But really, it's more about the AI actual penetration and ideas that they've got for monetizing it. But Microsoft up first tomorrow night, and then it's Meta on Wednesday. But there are another number of other things. Just to make sure you're all totally aware, you're either here on Friday, but it's in the preview, just talking about Bill Dudley. Hello, Rosie. Good afternoon. So Bill Dudley was quite a talking head himself when he was on the Fed. He was New York Fed governor. When he says things and it's being hawkish of late, then it's big news, which is why July suddenly got doubled in percentage midweek. He said they should be going in July. With the rate cut, things have changed. What he saw changing was the employment side of things, which he thinks it's very difficult to catch up with if you get behind the curve. Obviously, after the GDP numbers that came through, which, as we said, was only a catch up with what the Atlanta forward-looking Fed had told us was going to happen. Shouldn't really have been a surprise, as much of a surprise as it was. That's kind of ruled out July. But what's left then is definite September, and it may, depending on how the data goes this week, that might build to being 50 bips or even an emergency cut, etc. So, yeah, Japan, we touched on it. What can they actually do this week? They've had a bit of a curveball demographic report released, which shows you that they're obviously, as we know, they're a declining growth population, but it's worse than they thought. There must be issues therefore for how much debt they can service. They've got the biggest relative debt in the world, which is half the reason why they're not rushing to put rates up. So they have got an endemic situation. For them, to a certain extent, they'd like to see inflation get a little bit run away. So, if anything, that might lean towards what I said, that they're not going to do anything. They're hoping for help from the US dollar rather than having to do distinct things themselves. But what that will mean is we'll get a bounce back in UJ in the short term. 152 to me is your stop loss. But obviously with announcements, you can go straight through that, so you've got to be careful. But it may go through it and then bounce back up. It could be quite volatile, but unless they do something super concrete or their language is super hawkish, I think they'll be under pressure again by the end of the week. Something else coming out this week, and it's not the worst quarter of the year, but they're all big at the moment, massive auctions in the US, but it's the quarterly refunding announcement. That's telling you where they're doing it on the curve. Is it in the short end, 1 and 2 years, or is it bills even shorter than that, or is it more 7, 10s, 20s? Now that we've actually got the curve steepening and we know that they're going to cut rates, then there's more incentive for people to buy longer dated bonds. So they may well switch back to going down the curve. Prior to that, people obviously weren't happy and they were getting just as much money from buying short bills and they had a natural market. That's going to reverse going forward. So paradoxically, they might get away with it. People won't mind so much if they start shifting it back down the curve. That was a worry before, that there'd be lack of demand. And the other thing that's going to happen, leading on from what the Bank of Japan do, think this through. The only thing they're likely to do is reduce the amount of their own bonds that they're buying. So that means somebody else needs to buy them. But are you going to buy bonds that are theoretically going down in price because their interest rates, yields are going to go up? Or do you buy US bonds with high rates that are coming lower? So hence you're going to get a nice big price move, capital gain. So by definition, what the Japanese are going to do is going to help the US with their auctions. So that's just another boost. And then the lower the yields go, that gives a boost to other instruments and support for the equity markets, et cetera, et cetera. So as we go into the rest of the year, that's going to be very helpful for buying the next proper pullback, which is, we think, in September with the seasonality. So where are we for Friday? Non-farm payrolls estimate is 175. But some people are talking about 225. It doesn't really matter because it's all about the revisions. 90% of the non-farm payroll reports since COVID have had revisions and downward revisions, which, as we know, totally clouds the picture. So even if it goes up, people are now openly questioning whether it's a real number or not. They're looking at the household report, the other report we talk about, and that's the one with unemployment rate in. As I said Friday, there's always a risk that the divisor, the number of people working, the actual civilian labour force, that can be volatile, can move around. So if unemployment is going up and the actual dividing number, the number of people in the workforce goes down, you could get a big print, 4.2, 4.3, in which case that is nailed on panic time for the market. We talk about this thing called the SARM rule, an economist who made up a study, not made up, but did a study, 3-month, the average of unemployment rates. Once the unemployment rate has moved by more than 0.5% on the 3-month rate, you're normally heading into recession or rate cut required time. So we're right on the verge of that. That's what people are following, and they think that might even hit this week. So look at the household report and the unemployment rate first this week rather than worry what the number is on the non-farm payroll and react accordingly. Powell will reiterate it, and Dudley himself said that the Fed do not ever worry about the politics. So anyone that thinks that they're not going to cut in September, they're in cuckoo land, and obviously they're the potential to do November and December. Don't read that much into that GDP boost either. We mentioned it on Friday. The makeup of it, the durables good data, that's just a bounce back from a really weak and revised down number from the previous month. Exports were down, inventories were up, which means there's a lack of demand somewhere, both globally and within the US. So its activity is taking place, but it's not necessarily making its way to end consumers. So that's when GDP can be confusing. And where have I put it? I think that's the one I want to write down. Yeah. So this whole thing with GDP and recessions, I've gone on about it for weeks about how data can deteriorate really quickly. And we're now right in the middle of all this. Inflation is pretty steady, moving towards 2% in the US. GDP, when you talk about that, that's real GDP. So that's nominal activity minus what the inflation rate is. So it's running at 6.8%. So nominal GDP is about 5%. What is nominal GDP? Well, that is activity multiplied by prices. So if we know that prices are slowing down, we're also hearing that the price levels are what's causing the misses in earnings for the economy at large, the autos and the luxury items and some of the discretionary spend that's out there. Prices have gone too far, so the inflationary side of things is going to go away quite quickly because companies are just going to have to cut prices and or costs. And that means more job cuts. So both of those self-fulfilling in terms of rate cuts and the economy slowing. But what that means is if the rate of the price growth within the nominal figure is slowing down, and then you take off inflation, it's much easier to get to the minus figure. So let's say inflation is 2%. If the rate of activity growth is less than 2%, then real GDP is going to be negative. That is what, when you get two of those quarters in a row, that's when you've got a recession. That is why very quickly you can see a fall. Now, you don't normally get a nominal outright activity fall unless you're in a deep recession. But obviously the price don't go down unless you've got deflation. We've only got disinflation. But even so, as the prices come lower and they have less effect on the nominal GDP figure, the chances of that actually declining quarter on quarter becomes bigger. So we're right on the cusp of things going from, it looks like we're running at 2.8 to suddenly we're not. And that is why people say that the Fed should be cutting and should have been cutting quicker. So good things to be aware of, and just on a little helpful reminder on the mechanics and how that can help when you're looking at some of the data points. So in the preview, I said, what stock clues are we getting about the economy? So we've had Delta and Pepsi start us off with a whimper. GM and Coca-Cola were saying things were okay. Since then, we've had Southwest Airlines and Ryanair talk about the airline prices problem. Only EasyJet have said that there isn't. Look at the road crashing automobile updates all across the world last week in Japan, Europe, and America. Luxury totally smashed. The whole China pullback, but only a couple of them seeing any growth anywhere else either. And most of the commentary from the CEOs was all about prices not being sticky anymore. And Nestle specifically said customers have stopped paying up. They're doing trade down purchasing. So that's all telling you that things are slowing very, very quickly. Why did the markets blow up as much as they did last week? It was the whole risk-off, carry trade-off situation. You get margin calls. So if they're taking profits in the Make 7, they're going to take profits in precious metals. And unfortunately, 2 weeks ago, we had a lot of inflows from managed funds straight away to an all-time high and then coming off. If people are asked for margin calls, they take profits or just get out of their gold holdings. That's why gold wasn't a safe haven, although the yen, Swiss franc, and to a certain extent in Asia, the yuan held up a little bit despite cutting rates. So that was one of the extra reasons why gold was under pressure. And then obviously we saw some physical movement into the end of the week. So that may have well have blown a lot of the puff out of that. So we've since had a little bit of a bounce back. I said that we'll look at it again on the charts. We look like we'd hit areas where we could at least have a trading bounce, even if we're going lower. Seem to be well advanced into that. What happens next, obviously, that is the situation. We knew that the yen was going to rally a little bit because we talked about CFTC data over the last couple of weeks showing massive reductions in the short interest. By definition, that tells you that the selling of it was unwinding. I mentioned the rate cut 100% for September. Not only does it hit the outperforming stocks, but it starts that whole cascading of money fund idea. The carry trade is to invest in as risk-free as you can in another country, in America, in high short-term rates. If short-term rates are dropping like they were, that again causes an unwind of the carry trade, just to try and not lose from any FX gains you may have, as well as the actual absolute exit price that you're missing out on. I just like it. So you've got a perfect storm. So I mentioned on Tuesday, I think it felt very much like the 2008 deflation situation when lots of things were moving with positive correlation. There was no one asset that was suffering. That is normally when you've got across the board unwinding. That is risk managers either doing it themselves or forcing front desk people to take exposures down, and you saw the effect of what happened. But I think within that, it has been earnings is still ahead, and earnings haven't missed. There's no reason not to be invested. It's a relative trade, and tech earnings themselves, they were up. This was all a perception thing on relative capex and just a little bit of dummy spitting versus extreme valuations. The fact that the banking sector by Thursday's close was ahead of the Mag 7 for the year probably tells you that things have gone a little bit too far. Beyond that, so I watched a good interview with Steve Eisman, who works at Neuberger. He was one of the guys that was involved in the Big Short and big thinking investor, and he was saying the fundamentals have not changed. People just want to earn money in something else in the short term. That's probably something that's being in his circles. So it's not a real correction. It's slowing in consumer spending, like we said. As I mentioned last week, I put it again in the preview. This is a case of there is demand, but it's at the right price. So it's not like we've got total demand destruction. It's just because price discovery. It's gone, eventually people say no, and this is a healthy thing, and it's going to bring inflation down. We are still early in the AI story. So a stock that I'm actually looking at is ServiceNow at the moment. It has a lot to do with another stock that I'm working on, and their generative AI, and they are absolutely creaming it. People so interested in what they're doing, their products, doing this. Hi, Fato. Yeah, had a great weekend, thanks. They are running at the rule of 40, which is their revenue growth plus their profit margin is above 40%. They're in the 50%. So these are the bellwether for generative AI. They go like Banzai, absolutely cleaning up, growing like no tomorrow. And this is right down at the bottom end, dealing with companies on a day-to-day basis, using AI to clean things up. So it isn't a fad. This is actually getting done. And as I said, he mentioned a company, Accenture, who have an outsourcing side. Again, they're being asked by companies to come in and clean their data up so that they can talk to the AI application people. So there's two stages here. Everyone has to get up to the modernized data speed. Then they need to be able to use the tools to improve their productivity. So there's lots and lots still to play for here, which is why it should be a rotation and just pullbacks. We may have had the July pullback. I'm looking to fade the market into that late August, September top. And then you really do want to buy the Q4 rally. So, interesting. Hopefully, other people answer you. Sales spot. You want to know how to start trading, like which method, ICT, SMC, market profile. You got to find. I mean, literally, you got to try lots of methods yourself and find the one that you like. I mean, some people start purely with support and resistance trends. There's no right or wrong. The way I look at it is everything is in the mix. It's what actual fundamental and technical combination is in the ascendancy at any one point. So it doesn't mean that you're necessarily wrong. You just might not be right in that instant. So it is literally a case of finding what suits you, what suits your style. You might be a short-term trader, a long-term trader. You might prefer to swing trade with being totally all over what the fundamentals are telling you and then looking for anomalies in charting, or vice versa. You look at charts and you predict. It helps you predict what might be happening in the fundamentals, and then you boil it down to which assets are then best to be trading in that environment. Or you might literally be someone who doesn't look at news at all. I'm not saying you can't do that, and it's not an insult to say that is more limited way of looking at it, because you can make a lot of money and be successful, but it doesn't give you the fuller picture. And by limited, I mean it will make you stay within the sort of price action parameters of an instrument you're doing. If all you want to do is do that all the time, then and it's successful, go for it. But it is quite a stressful way of doing things. And it is frustrating when it's not working, because you suddenly have to do a lot more testing of your models, etc., etc. So find something that you can back test and eventually forward test, because it does work both ways. Try and read as much as you can. Learn fundamentals. It's a kind of osmosis, bury yourself, immersive process, just like it is with learning and watching price action. Price action is a lot. If you watch any of the videos that Riz has been doing with market professionals, look at my original videos when I joined the firm, talking along similar lines. In the real world, technical analysis was always left at for a long time. A lot of people still don't do it or admit to doing it, even though they are doing it by default, because price action watching is kind of learning patterns without necessarily applying the indicators. You just start to get a feel. It's different when you're on the right side of the market, because you're in control of a lot of the flows, and you're seeing the flows, and you're talking to the actual button pressers, etc., etc. Whereas at our end of the market now, we're in a bit of a reactive mode. So we have to be aware. It does help to get you in and out of where the trends are by being involved and looking. No problem with anybody using any of the things you mentioned. A lot of the things are based on technical ideas that were present 20, 30, 40 years ago. They've just been tweaked and they've got new names. They're all basically around the same essence of the support and resistance, and looking for where volume blocks are, volume profiles. Some of the tools that are available now are amazing, so it can help you have an edge versus people who don't use those tools. So I think don't get yourself blinded that there's any one super wins all combination. It's tweaking, finding, learn as much as you can, speak to people. Having a consensus of ideas and what's going on is helpful. You don't have to follow it. Often not trading is as important as trading. It's just getting used to. It's like getting in a car and having to read the road ahead of you. You can't just blindly walk along, not looking at the mirrors, not looking who's coming onto the road, what's around the corner. You got to be prepared for it. So obviously I look at it in terms of elliott waves, because that's something that I have done for a long time. Thank you, Fato. I do that because to me that is a sentiment and kind of market setup situation that mirrors how people trade, that is in waves of sentiment and emotion, as well as having a lot of trend lines to it, natural support and resistance lines, and a lot of patterns. So it's helped me, and to me, it's something that helps you identify when the fundamentals are at play as well, at least to get you out there and looking and checking, because certain things will suggesting itself from. But as we're trying to teach as well, get into the data itself. Don't just trust on how the market's moved. The market's often wrong. Don't just listen to people parroting the releases coming out by looking at it, what has actually made that data said. And often you will see one or clues in the data that's going to tell you what the trend is in the big daddy boy print, the PMIs, farm payrolls, and then you can position yourself and look for things that technically are telling you that's not going to happen. You know that they are possibly wrong. It's all it's a big jigsaw puzzle putting things together. So and it is quite daunting, but don't hide from it. Start off and get yourself amongst them. So hopefully that isn't boring for everyone else. I think it's always good to talk in those lines. It's just a good way of thinking about how to look at markets. So I mentioned Microsoft Tuesday. I think they should be possibly. Let's be worried if Microsoft have a big problem for the market if Microsoft mess up, because they should be the pure play AI growth stock. Better, as we said, Alphabet Light, Amazon. That's the one that looks at everything. And then Apple. We've had lots of upgrades last week, all on the AI expansion. Don't get caught up in the two headlines you've got on the media, which is just push back the actual launch of AI into the new phones, but it's only going to be a short delay. And also, they're not in the top 5 in China anymore, but that's down to China forcing people not to sell them or buy them, as a sort of hits back at the US. So it's not necessarily an issue. And let's see what happens if Apple phones are suddenly the AI future. Then there'll be a way. China will find a way of getting around that. So, are we still showing the right picture? Yeah, good. Right. So in the weekly, that was the last print in gold from the comics. There were 69 contracts that had suddenly been stopped, which meant they need to be delivered either by tomorrow. Well, they need to be delivered by tomorrow, basically. So hence, I think we had a little bit of a scramble going on in the Asian session to get some of that in. Obviously, the little pullback, they've either been filled or they've actually found someone at the big figure willing to sell. That's where it seemed to run into a little bit of supply. But always good to know every time that CME page. I put it up a number of times on my chat. You can find it by going to the CME group and looking through, but it's in clearing, operations and delivery. And then you get a delivery notice. I do it daily, monthly, and year to date, so you can see where all the hotspots have been. And on Friday, we'll see if we can catch up with where the actual leasing rates are to see whether there's still some pressure building on actually being able to find physical. But I don't think you can trade gold at the moment without thinking about the physical side. So have a look at a few of the setups on some of the instruments we look at. But as we know, midweek is going to be a real pivotal moment this week, so be aware of that. We've got so many things at play, stock-wise, treasury issuance-wise, 3 central banks, loads of big data, ISM data, loads of jobs data. It's almost close your eyes and hold on. I do think that we are potentially set up for this new all-time high again in NASDAQ if nothing goes wrong. But it's just like going through 100 meters hurdle this week. You've got 7 or 8 big things to jump before we get there. So I expect some volatility. Yep, non-farm payrolls on Friday. And ISM manufacturing on Thursday. Because the first of the week first of the month is Thursday this week. So yeah, on the gold picture, we bounced off that big demand area that we talked about. Gustav has done a really good chart on all the areas for fair value gaps and order blocks. Well worth a look on my chat. It's very good analysis. And he's been absolutely knocking it out of the park for a few days. So wouldn't put you off having that as a roadmap in the short term. We talked about this 24, 30, 40 level, which is the pivot point for the first three waves down for me, which is still potentially the wave 4. This wave 3 could be the minor wave 3 top. It all depends on how this current structure plays out. But at the moment, it's still valid to get one more breakout into the 2500s, and where we always thought that the wave 3 was going to be. So the top of the current channel and that wave 3 2 spot 618 fib are still in the same kind of area, and an mid-August top along with other markets topping. You can't rule it out, but in the meantime, we could still extend unless we take out, because this is a sort of overlapping ending diagonal. Unless we take out the wave 2 down here, it's still potentially valid. It gets weaker the deeper it goes. But we said this is important. Can we get to 2400? We've done that. We were then concerned we might have a double correction. So this whole drop down of, was it 124.80 to 120 points from that top brings back in the whole challenge of 2300 to 2280 again as a potential top. We talked about spot 618 of that. So 60% of 120, so 72 off there brings in that 2330 level, which is over here where we had obviously seen a consolidation wave before. You guys will talk more about that being order blocks and fair value gaps, but it was right in the middle of what I had as a strong support level 3-wave consolidation wave in the first leg up of that all-time high. So it was an important breakout level. It'll probably be defended quite aggressively. But again, we've so far run into this big demand at 2350. It's all about whether that holds on a pullback if we actually go back there. But for me, it could easily be in a 5-wave move up. It comes all the way to the top of this channel. We've either bought this. So I think that 2350 level is your stop loss for the moment, just because the ultimate downside could be another 3 or 4%. But I am still leaning towards being another all-time high in the near term. So just be careful about getting whipsawed. Make sure you are protected. At the moment, it is a trading range. So use your whatever you use for your short-term indicators to find your levels, because we are the way that I look at it, we're in a mid-range. So that is close to an equal legs consolidation, which could rally again, may actually be rallying. That is because from the top of the daily range to the bottom back to there. So yeah, it's a spot 618, which is the kind of least valid I have for a 3-wave. We could be bouncing, but equally we could be coming back down to test 2380 at some point. So kind of mid-range. We need a new high for the move to take us higher, don't we? By definition, which is back above 24. And probably, 2 ways of looking at it for me. I would either buy that when it comes back to 2380 for a trading buy, or I'd buy the breakout. In here, it's kind of no man's land for me, the way that I look at it. And then I'll double check. Is the LPR boys, where are they? Julie's always interested whether we're getting water or not. I've just suggested this having 3 standard deviations on it for my own sub. It's really where the coloured lines are. It's still the 2. So the white line in the middle is green, and then the light blue and light red are where the 1 standard deviation is. So it's whether they're in the darker zones, the 2 standard deviation channel, and we're in no man's land at the moment. So that's why it's not a buy or sell. For me, obviously, my rule, it has to be within those channels are moving. If it comes outside, it's when 75% of it comes outside, which is why you didn't take your sell off until you're in around here following that method. Basically, this has been trading no man's land most of the day, very few signals, and it hasn't really, well, what have we done? Kind of, we haven't had a close above the 2 standard deviation line. We had 1, 2, potentially 3 there below the lower band. So at some point, it is going to cross this blue line. Depends where the action goes. That doesn't mean it can't be coming down, doing it in low momentum. But just be careful on your shorts that there isn't still a second challenge to 23.95 and above, which is why it's no man's land. You're in the middle ground of a normal distribution. So you are, unless you've got other indicators that are telling you that it's a pure buy or sell, then I wouldn't be playing. So the dollar is the annoying one at the moment, because we have started seeing a bit of strength over the morning, haven't we? Is that just a bit of geopolitics? Is it just on hold until Wednesday? Are we in a dead space? But sterling and the euro are both retracing, and the dollar here, which we're hoping had entered into the fifth wave down, looks like it's doing an extension, which again, it's now hit the spot 382 pullback completely, but it looks like potentially one more little wave up for that to happen. Who's that? PAV 104 set here. Just about to prove that, I think. So if that was a top, then that was the connector. Then yeah, it looks like we're right on the 61.8. The one is up there. We're somewhere in between there for equal legs for the wave 4. I don't think it is any more than a wave 4 and a little bit of short term. Just finishing off the pattern. Remember, we said the other week we thought when the Trump thing happened that this might end up being a little longer than we hoped originally. It is playing out, but we do have one more leg down to come, which I think may be around the whole commentary on Wednesday night, if not the data. I think we're definitely in the whole idea that by definition we're 100% on for September. So that is a bit of travel and arrived. Can we get the dollar bottoming out into the end of this rally for what I still see risk on suddenly coming back after this week? Confirmation of rate cycle, blah, blah, blah. And then where do you go post-September once all that's baked in? It's seasonality, and it's a long time to the next earnings season. It's summer and data. So that's why I do think we're still going to get one more low into the dollar, regardless of what's happening in the short term today. But very close to confirmation of that finishing the uptick again. And Fato, yeah, I think unfortunately we're going to be in no man's land for a lot of things this week. So just let's not get caught up in overtrading. There are going to be some definitive trends set in the next few days. So just like we said last week, staying in the game rather than necessarily catching tops and bottoms is the name of the game this week. Let's make sure we're rock solid on what's going on. What was I talking about earlier? The whole UJ situation. So I remember I mentioned it on Friday for those that were here. This was the potential stopping point at 155. It was an original equal legs, but we said it could have a bounce, and if that gave way, we'd have another equal legs, which just below 152 is level. But 152 is a massive options level. It was a barrier triangle horizontal line for the best part of 2 years. It's a very, very important thing. It's a classic situation, particularly for the guy that's asking earlier about what profiles to use, sales spot, but maybe a lady. That's the classic of resistance becoming support situation, and it's bounced off that in the short term. But by definition, whatever happens on the mixture of Wednesday is that we're very close. The movements could be 4 or 5 yen either way. So even though you've got a stop loss, just be careful in the current environment that you might not get the right deal. And by definition, it may be that you might want to wait for confirmation of what the trend is. In the meantime, so 4 could well have happened here. There is 5 waves down there into that 152 bounce. At the moment, we're just consolidating. So are we coming lower from that, or is it consolidating to go higher? It is literally a coin toss. We don't really know who's in the ascendancy, but all we do know is that there's been a lot of unwind, a lot of carry unwind. This is at maximum short-term unwind pressure, really, isn't it? So the line of least resistance, nothing new happening, is back up. Because in the overall pattern of things, we've still got a swift wave to put in at some point. My friends Bodge, I hope, are trying to rely on the US. And obviously, we've got 5 or 6 weeks to go before we get there. So if they don't deliver this week, there's going to be a number of periods, particularly in a risk-on environment, where people will borrow yen and put it to work, even if it's just for another month. So be very careful on this whole UJ situation. So I'm just getting my. So I was looking at this at the weekend. Sterling looked like it had one more potential low in here. This is for an equal legs. We're right on it. We're trying to bounce off again. It's all about relative bets now. The Bank of England are behind on the rate cuts. They really need to get them in there just to get start and already bleeding at the eyes. Consumer wages have sort of topped out. The only real thing that was left in the way was the services read through from Taylor Swift. And she's coming back in August. So data are paying and some year-on-year benefits, sort of September, October, are also going to be difficult to potentially justify on the data alone. So they probably need to go on Thursday, and that's why consensus has moved more towards being a cut. But the language itself just suggests that they're going to be very, very data dependent going forward. Why will they do it? Because they know that the Fed and ECB are going to go again in September. They don't really want to be too rate cuts behind with very little chance of doing at all. So I think they have just to get themselves back on the page. And remember the vote, ignore what the vote was last time, 6-3, 7-2. Because Pill, even though he's been making hawkish noises, will either abstain or do whatever Al Bailey tells him. The other 5 will buy into that, and he only needs Al. I keep mixing all up. Bailey only needs 4 people to vote for the who will be the casting vote. So worst case, 5-4, and it's more likely. I think consensus is 6-3. That's including Pill being one. So it could easily be 6-3 or 7-2 in favour, or it could be 6-2 abstain. I just think that the setup is there. If not, and after that, because of the relative commentary, Sterling catches a bid again. And obviously, if they don't, then we really do get the full effect straight away of what will be a wave 3 in Elliott wave. which is, for those that don't know, that's the strongest wave in the patterns, any of the degrees. And so this would be a third wave minute. It's quite a powerful one, and it's within a minor wave 3. So we're kind of expecting that, hoping a lot of the work was going to be done by the US dollar. But for a while, it's all about relative bets. Any other questions while I waffle on? So I'm not really going to do much more. I did want to show this one though. Okay, right, just a couple more. Does everything make sense? Is there anything that anybody massively disagrees with? Because I'm not here to pretend to be right on everything. I'm trying to debate. Not really. I'm just going to quickly look at that only on the basis that I think the Nasdaq potentially has bounced. This was just the Nasdaq versus the Russell 2000, which is the candle chart. That's down 17% since the 10th of July. Within that, the Nasdaq was down 11%, and so down 9%, and the Russell was up 11%. So sort of 20% swing round. Very, very excessive in the short term. We haven't had anything move like that for years between those two, all on the fact that the rate cycle is turning in just some. I just think everyone was so overly hidden in the Mag 7 that rather than it being anything particularly due to the valuations, it was just, as we discussed, the heavyweights being sold relative to the lower weights being bought, you could get a mega blowout. Now, rotation could still be in play because it is very difficult. Once the oil tanker has set sail, it's got all that weight of money on board and it has to be deployed. But we're probably at those extremes in a situation where the market makers, the sell side, might be happy to accommodate a lot of the trades because it's so extreme, in which case you don't get as big an effect unless there's some events happening which allow them to manipulate the market in their favor. But just based on the pure thing, they'll be expecting mean reversion. If they were asked to price an outright stock portfolio switch in those, now that the prices have moved to the extremes they are, you'd probably find the market relatively bidding up for them, because particularly with the setup of the earnings coming through this week, it has a bias to mean reversion in my eyes. What does that mean in layman's terms? Then we're going to go back to the trend we had before, so you'll see some relative outperformance of the NASDAQ 100. I mean, they could both carry on going up, but with the tech stocks outperforming, but equally, you might see people just unwinding the benefits they've had for what is basically a 2.5 week trade. So the answer, Fato, is potentially, but I think the effects of it are minimum at the moment. But it's all about, I said, there are a number of situations that could happen in the NASDAQ. We either put in that primary wave 3 and we've entered into a fourth wave pullback in that channel, of which we've nearly come across. The trade itself, nearly 100% equal legs, then we started bouncing. Now, there's still, to me, a potential for this being an expanding diagonal. You don't see them very often, which is why it's a low base case. It could still be in the red waves, the minor waves, and doing form. So A, B, C. So that could be valid for the current thing to be 4, and we've still got to put in this situation, the 3, 5, 5, 3 still yet to happen. But the most likely, so I don't like relying on low probability setups, is that we actually came forward, and that was the high degree third, and we've since more or less put in the 4. Now, obviously, we normally go back to the level of the wave 4 of 1 low degree, which is what I said on Friday, which is this channel here, where it says the wave 4 zone. Didn't quite get there, so there's potential that we carry on rallying a bit more and then sell off again for another equal legs into here, which again will be a simple sort of 18,000 test. But originally, remember, we talked about 18.7 to 18.5 being the sort of target zone. We may have got away with that. All depends on the results. That's what we've got labeled in here. That is, yeah, they're the 2 setups for equal legs. Should we get a rally back up here? So let me just take that out. And build it again. So that's for the current setup being the blue wave. The other potential is that we do rally and then it fades back towards a big figure, 20,000. Which is what I was suggesting, is that the equal legs for that puts us firmly back in that wave 4 zone, 18,000. So both of those could be valid, and it could well be that the next run takes a long time, takes us into that mid-August sell-off we're talking about, in which case the second leg down could end up being the seasonality that sees us just complete the sell-off. So that is the weak bull case is that we don't put in a new all-time high, and that we do a double extension that takes us to 18,000. Then we rally into the election once we get deep into September, which is not impossible. But what you've got to remember, if we go through a scenario like that, that's potentially what have we got? We've got NVIDIA here, I mean, 26. Boom, boom, boom. I'm not sure that NVIDIA are going to disappoint, to be quite honest. So I'd prefer to see us play out with the, as we said, 3, 4, 5 exhaustion into a new top, and then a travel and arrive, which is post NVIDIA going into September, fundamental rate cuts, knowing full well that that's the best. We know what the path is, and then full on seasonality. But we just have to be. So that's probably that's my first case, and then the second case is that we fail at 20,000, which would be after this week's rally probably. Anyone happy with that? So at the moment, I would have, if you're playing long, then you got last week's Thursday low, which is your 18,700 is your kind of stop loss. Just if we fail through earnings and data events this week, then we are going to do that double for another 5%. Just be careful. So I've got a couple of ideas, but I need to see a new high for that to confirm, and we've got, as I said, 7 or 8 hurdles through the week to get through. So it could be choppy, but I'm expecting, as long as nothing goes wrong, I'm expecting net impulse to the upside with small corrections back. That's my base case for the next 2 weeks. I'm not really going to go through anything else because they're all going to be a similar setup in a way. The S&P is bouncing off the same channel low that Nasdaq is. FTSE, could that have a kicker from the rate hikes? Again, the rate cuts, sorry, it has taken back its 50-day. No, FTSE is interesting. Don't know, Mako. Sorry, you got Go and speak to the mods. They've got the information. But yeah, GBP is going to be a slower cutter versus the euro. I think it's far worse in Europe and more demanding of rate cuts. Yeah, just finally, the FTSE just have a little impulse to it, doesn't it? That's building up for relative rate cut, building up for risk on bounce back. Really, it's a globally affected index. Really, lot of dollar earnings, and we've got a positive dollar today, so that's why that's kind of bouncing, I imagine, in the short term. But this was always going to be the point of interest. We need to see that X level taken out and hold in order to be up to put a challenge in for 8477, which is another percent higher in order to be in an up wave. I'm kind of expecting this to be connect to pattern, but we'll see if we get global risk on again and we get a rate cut in the UK. That has a potential for breakout. It's slightly ahead of what I was expecting from last week, but again has failed at the key level. What was life like at UBS? Depends what years you were talking about, but in general, absolutely fantastic. Yeah, we were global. We were one of the first people to go fully sectorized in the way of looking at equities globally and in Europe, and we're more or less number one derivative house versus Deutsche Bank. We had different ways of looking at it, but we had a fantastic model of building derivative exposure, gamma exposure up from base up, having exposure to dividend changes to make lots of money. It's real fun times. I wanted to go and work at a hedge fund, but obviously I moved right at the start of the big crash, and we were making more money out of a hedge. Things were going to go absolutely crazy, and we had the opportunity of moving into Liberum Capital that was starting up just down the corridor with the same seed capital guy, so it made sense to go and hide away again on the sell side. It's a shame because I'd always wanted to stay on that side, on the buy side, but wasn't to be. Sometimes things just make things up for you. But I had fun time there at Liberum. We built up a desk from scratch right at the time that algos were starting. We were the first people to have what's called a sprayer because we had access to people all over the market that we'd worked with. Then we were right at the forefront of algo trading and developing that. So fun times, right on the start of moving from manual trading through electronic trading, and yeah, brilliant. So it all really fun times at both of those. But yeah, no, sometimes you get your position made for you. You have to live with it. It was great for me because the GFC was the 2008 crash was basically a living, breathing A-level economics and trading textbook. So I was very popular and wrote some really good stuff. And I was back to a lot of trades and did a lot of sort of portfolio trading for the house. And also, yeah, it's good. It's all good fun. No, it doesn't really work like that. Plus, I don't really want to. I've had too many years going up and down there, and people want you to go back into London. I'm at the stage where I'm happy to do my own stuff. So it's a good life. It's also a stressful life, and I think I've done my stint. I'm happy to be doing it from a different angle for now. Any other questions? If not, I will chat to you on the chat. Come in to me with any questions you have at any time, and we'll speak on Friday after we've seen all the fun. It'll be a great week. Just be careful. Yeah, just make sure you're still alive. Yeah, cheers, Pav. Everyone, take care. Thank you, Bletchley. Thank you, Reactor. Thank you, Vivi. Good to see you. Hope you're well.